Hello, everyone, and a very warm welcome to today's Majors Markets Update for January the 22nd, 2025. We are steaming ahead, and we can say last week we were right and wrong at the same time. How is that possible? Well, please remember that the short term is always more variable than the long term. So we have short term variability and longer term relative certainty. It's not, of course, 100%, but we are more certain about the long term. Why is that? As we already foresaw in early November, a top around 6,060 for the S&P 500, then a drop to about 5750 plus or minus something, and then a rally to at least 6,200, potentially 6,400. That's what we foresaw in November. And of course, we do not know the daily scribbles ahead of time, how exactly that's going to fill itself in, especially not for a fourth wave correction that we've just experienced and which ended on January 13th. We got three waves lower, and that could have been all of it, and then it decided to protract and become a double zigzag. That's always possible, but we reached the downside target zones, and those target zones are all that matters. It's just simply impossible to forecast every single daily scribble. So with that in mind, we will also go over some of the hourly charts that we had where we thought we had 5 waves up. It looked really great. Again, you nailed 2 out of 3 Fibonacci extensions and retraces, and then the market does something else. And that's why we always say that within the Elliott wave, we are about 70% reliable, because the market can decide to do whatever it wants, as long as, of course, in this case, the third wave is not the shortest wave. Then, for example, possibly the fifth wave can extend. Nobody knows that beforehand, and that could be a possibility at the moment. All right, so that's what we're going to track, and it is up to you, dear members, as well as other listeners, to manage your trades properly. That's why we have our warning levels in place, and in this case, we have warning levels for the bulls. You've probably heard me never say that you should short this market or go long this market, because I cannot give, of course, trading recommendations because I'm not a certified financial analyst. However, anybody who is worth its weight in some salt should know that in a bull market, you just don't short, you buy the dip, okay? There's no reason to short any of this. Please do not do it. Oh, we might get a couple of down days, but I view those still as buying opportunities, because the market is still tracking along a ending diagonal pattern really well. And remember, if you short a bull market, your gains need to make up a lot of losses. If you're down 70%, you have to make up 233%. Forget it. That position can be thrown in the trash can. So don't, and that's my only trading recommendation. I also recommend not selling, honestly, as I really believe we're going to that target zone, contingent on holding above the warning levels. All right. That's why we, for example, have stops in place, why we raise our stops, all those things, because there is no 100% certainty, only uncertainty. And here is a list of beautiful things you can sign up for if you so desire to make even more money or money in a different way. It's all good, whatever floats your boat. So let's go straight to the charts and show you why we were right and wrong at the same time. Okay. So this is the chart I shared with you on Friday. Of course, we have a few more days of price action with it, but we had a nice top here exactly at 161.8% extension. You see this from the gray wave too low to there. That's normally the standard third wave. Then the fourth wave normally goes to about 100%, but it can stall also at 123.6. We fell even short of that one, but this was enough to label it as a fourth wave. And then the fifth wave typically goes to 176.4 to 200%. It's not on here. And then since this fourth wave did not bottom exactly where it had to, give me a break. The market does what it does, but we had a nice retrace. We could raise this target zone a little bit for a extended fifth. And what did we see? We topped here right in this target zone. We started to decline for 3 hours, and that was it. So this wave count was correct here, correct here. It was also even correct for the wave 2 low here. Everything was correct until the last 2 days. All right, last 3 days. market started to extend, okay? So that is a problem for this wave count. So this wave counts out the window. So this one was first right, and then it turned out to be wrong. And this is the variability of the short term, unfortunately. So we're dealing either with a very extended fifth wave. It's very possible to about 61.15, somewhere around there. It's guessing at this stage. I'm still looking for one final wave higher than to complete this potential 1A. All right. This is the potential. It's a very extended. And here I'm simply counting, of course, down hours as corrective. 2, 4, 6, 8. And this is the number of waves. An impulse is 5 waves or 9 waves if it extends, or 13 waves if it extends further, or 17, 21, whatever it desires to do. This would be a very extended fifth wave, but it's not impossible. This is always why we say, you know, we anticipate, we monitor, and we adjust. So you anticipate a high initially here when no data has been filled in, then you adjust because we have a very shallow wave 4, and you get a higher high, and it topped there, but it decided that was just a smaller top. That is unfortunate. And again, I do not recommend any shorting in this market. Please do not do that. If you so desire to do it, you're on your own. This is still by the dip. So yes, we can see easily from there a 100-point correction to about 59.40, potentially 59.85, or even as low as 5900. All right, so that will be a 200-point correction. It's very possible, okay, that's going to happen. This is one possibility I'm seeing at the moment. The other one is that we are in a barely subdividing final wave 5. That would be a hallmark and typical of a fifth wave. So then we have 1, 2, 1, 2, 1, 2. Okay, that's pretty much what we're at. And we're now in 3, 4, 3, 4, 5, wrapping this all up. And this is why we put those warning levels on the charts. Okay, this is why as long as you stay above these warning levels, there's really nothing to worry about. The blue one is the first warning level. That means the bears, because it's a bull run, have a radar lock on the bulls, right? It's like a war game. And then the second one, the gray one, is of course your proverbial shot across the bow. All right, bulls, start paying attention. This is a first set of lower lows and lower highs. That is a bearish sequence. The third warning is the second hit, is the first hit, and the warning is the second hit. Please mute your microphone for those that are listening in. And we are going to raise those warning levels. I prefer to work on the daily time frame. It is more certain than a hourly time frame, which has so many more scribbles that it is, of course, fraught with interpretation issues. We've broken already well above this downtrend line that held the B wave and the B wave of the C wave in check. All good. So that was our sign that this bull run was underway. So now the first warning level has been raised to 60.76. The second warning level to 6,006. The third to 59.30. And the final one is still, of course, at the January 13 low at 57.73. Okay, that is, of course, the final low that needs to hold, but so far it looks really good. We're above the Ichimoku cloud, above the moving averages, all that good stuff. So I can clean up this chart, and I think we made a new all-time high. Now again, we can still subdivide like this, or we're going to continue massively higher. Let me adjust the chart there for you a little bit, as stock charts has moved some of the lines a little bit too high. So we should see some of this going to happen, right? It's still the same deal to the 176 to 200% extension for this wave 5. Okay, and again, we can have 3 waves up, or we're going to get 4 or 5 waves up to be determined. I mean, 5 waves, 4 or 5 sequence. That I don't know yet. Okay, that we cannot predict beforehand, so we have to let the market decide. I shared with you the NASDAQ chart yesterday, which so far still only has 3 waves higher. And you can also clearly see it, of course, here with the one down day we had. All right, so 1 up, 1 down, and now a second leg up. So that's still a ABC, which is fully normal, as we believe this is a simple ending diagonal. However, for now, we have 0 signs of a top in place. At the minimum, go below 6,006. All right, I would not want to see it go below there. That's a serious warning that this sequence up from the January 13th low has ended. And then we're most likely in a B wave or a second wave pullback. Okay, that's what we're seeing here. And the other one, if we continue to hold all these support levels, 1676, 1615, etc., we'll just subdivide higher. I cannot distinguish between the two, unfortunately. I wish I had a crystal ball, but this is pretty much the best we can get out of it. Again, this is a bull run, and I'll have some other data points to confirm that. So watch those warning levels. They're on the chart, and I just spelled them out. Also here for the NASDAQ 100, again, we reached 161.8% extension. We bottomed a little bit closer to the ideal gray wave 4 target zone. I shared that with you on Friday, and then we should have rallied here to this wave 5 here, a target zone somewhere around 21,400, 500. We did, and the market decided to subdivide. So this was first right and then wrong, okay? That's why I said we're right and wrong, and that's why we always say we are wrong till proven right. So this was unfortunately not correct. We did not get the pullback, not at all. And you will not trade the pullback until there's confirmation by breaking below these warning levels. They're really easy to use, and even then I really prefer to wait for daily closes below those prices, because primarily the daily chart should be used. I'm not too keen on these hourly scribbles. All right. So then we have this subdividing wave 5, equal to what I shared with you for the SP 500 underway. That still requires another little leg higher, in my humble opinion, contingent on holding at least above 21,756. And if we go below 21,332, it's really severe warning that the wave 2 is already underway, as I shared with you for the S&P 500. And the alternative is, of course, this subdividing larger fifth wave underway that will just see a 4, a 5, a 4, a 5, a 4, a 5, etc. And it will go straight to the bigger picture target zones. So keep an eye on the price, okay? The eye on the price should be there. I know people most of the time like short-term trading. I've moved more and more away from it. I am much more of just a swing trader, holding on to these positions for a longer time. I've noticed the returns are better, it's less stressful, and you just don't have to follow everything for every scribble. So the first, but whatever floats your boat. The first warning level here, again, 21,756 for the NASDAQ 100. The second one is, of course, yesterday's low is at 21,375. The third one is then, of course, that pullback day. The low there is 21,085. And then the final one is, of course, the January 13 low. So those are the warning levels for the bulls. If we go at any time below 20,52.3, for whatever reason, this wave count is, of course, completely invalidated. And we never trade without any stops, okay? It's never wrong to take profits along the way. Partial profits is a really good strategy. And then at the end, yes, you'll be left with a small-sized position, but you just cannot let it run for as high as you'd like until there's, topping confirmation. But again, I still believe this is wave 5. We're not yet at an all-time high on the NASDAQ 100, but so far, so good. Let me pull up the regular NASDAQ and the chart I shared with you yesterday to show you that we're in this C wave target zone. No, not this one. Excuse me. Right here, but no signs of a top at all. Okay. If anything, we're at the upper Bollinger Band, and the Bollinger Band is expanding. So it has strength, full on breakout. So this looks bullish, and I still believe this can go into the 22,000s. Moving on to the Dow Jones, nothing to see here either from a bearish perspective. Still looks strong. We're now above the Ichimoku cloud, the 50-day, the 10 and the 20. Not yet a full-on bull market signal, in that the 10 would be above the 20, which would be above the 50, right? That's kind of what you would see here, akin to August through October. But everything is starting to rise again. We're well above the rising 200-day moving average. So this is still looking really good for this potential wave 5. There is an alternative for this being a C wave of a larger irregular bounce, but I have zero indications that is the case. It would require at least a break below 42,920 from current levels to tell me, yeah, we've topped out. So please never take anything for granted. Just make sure you always protect your hard-earned money. There's been a wonderful couple of days on the long side, so maybe it's time to ratchet stops up. My ETF trade alerts have been long since I believe January 15, and they're taking profits along the way on the Dow and the S&P 500 semiconductors. Tech, it just went along, but tech is lagging a little bit, I would say, but it's okay. Poor old Apple, I guess, is weighing on tech. All right, here we go for the semiconductors, and what a ABC mess. It is a clown show out there, honestly, since the August low. This is really bizarre price action, and this is, for now, the best interpretation I can do. We can't slap on a 1-2-1-2 sequence. Then the rally in August was 1, the September low was 2. This would then be a leading diagonal, leading expanding diagonal, wave 1. And then a double zigzag, almost a triple zigzag, wave 2, and now in 3 of 3. But I have problems with this price action. Is this also expanding, leading diagonal, wave 1? Boy, you see, when price is this sideways and overlapping, Elliott wave is just not the finest tool to really be certain about what's going to happen. Anyways, I think this is still on track for gap fill at about 5,700. So as I said before, eye on the price. That is a nice confluence for these 3 different wave degrees of C waves that are underway, in my humble opinion. That's my best interpretation of the current price action since the August low. So the first warning is essentially today's low at 54.33 for the bulls, of course. Then the second one is yesterday's low, 53.05. And then if we go below that 51.55, that pullback day, things start to look really bleak for the bulls, because then it's going to be hard to make this a true 5-way up case. But not the end of the world. It remains, of course, the January 13 low. That is the ultimate line in the sand for the bulls. But as you can see, we're strong and long. This looks really good, and I think that gap can be filled, and then we'll see again. Again, this is not my preferred index to trade or Elliott wave, so to say. And if I don't like the Elliott wave, I won't trade it either. IWM, yeah, had a minor pullback today. Nothing new to say here. Still believe that it can go higher for wave 5. But note the overlapping price action ever since the August. I mean, this is a disastrous, so to say, for a Elliott waver to anticipate. This, once this low is in and you have your initial advance, nobody knows, for the love of God, that this is really going to transpire. So please be aware that this could be really ugly going forward in trying to reach the 253. So we hold the same warning levels for the bulls on the chart. All right. So those are the price charts. Price is king. Price is the aggregate of everybody's market participants' opinion at that given moment. And that's the one you trade, only price base. And that's why we always assess price charts first. Not news, not opinions, not tweets. None of it matters as much as actual price. This is the bullish percent index for the S&P 500, back above 50. So it's a good, strong reversal, and it looks good. AD line already made a new high recently, or over the last few days, sorry, and already broke out way earlier, I believe January 14, 15. That was already the sign that the downtrend that started in December had ended. And as you can see here, we really held below this trend line, and then a breakout above it. And I shared historical evidence with you, is then a very good indication that the downtrend has ended. Let's go to the McClellan oscillator. It's currently at 71, but yesterday it closed just above 100. And closes above 100 don't happen too often. I only have data going back to 1998. So that's almost 30 years of data. And over 100 happens about 30 times, okay? So that's once a year. So that's quite a rare signal. What happens to the market when we get these rallies above 100? Well, first of all, I want to, of course, exclude bear markets. Bear markets are, of course, like a year-plus long decline, and we're clearly not in one. So all of these signals that we had in 2022 can be excluded. And so, of course, can the signals here at the end of 2009 and here at the end of 2002 going into 2003. 3. Why? Because those are all bear markets, and we're not in a bear market. We just made a new all-time high, not a new low. So we're going to delete all those. Okay, we have to compare apples to apples, not some bear market behavior where you have very strong rallies. What do we see? Well, of course, the first one here is right at the end of the bear market that started in 2000. All right, so 2003 low. The next one was right after the 2009 low. Okay, that's really good. Then the next one was after a pullback in 2009. And as you can see, consistently, except here for 2011, we have continuous strong momentum going forward. Even bounces are included. Look here, 2020. Of course, a multitude of these readings in quick succession is a really good sign. But as you can see here, 2022 low, right here at the March low, 2023. The preponderance of evidence is once you get over 100, yes, we might see some pullback short term, but we also will see good gains going forward. Okay. And yeah, I don't have the exact details, of course. Now, this signal here fell a little bit, of course, on its face because eventually we got a lower low in 2017, but still there was a continued momentum to the upside. 2019 as well, clearly 2020, 2022, 2023. So if anything, if we exclude the bear markets, long side upside reward seems to be the theme here, which goes well with the Jenkin money flow study I did, showing that we had the lowest reading ever for the Dow Jones on December 26th. And the only one that came close was something from May 1970. All right, when most of us weren't even born. I wasn't even born. And that then led to a 35%, no, 55% rally over the 3 years. So yes, that all looks really good. This is simply another line of evidence that matches also with the summation index study I recently presented to you. So all of this is additional evidence that we should enjoy higher prices going forward. Again, we have, of course, our Elliott wave that suggests only 64, 6,500. Okay, that's what we're looking for, right? 64, 6,500. But from current levels, that is still almost 10%. That's not too shabby at all. On a 3-time ETF, that's 30%. Put in 10,000 and you make 3,000. You know, that's nice money. All right, that's that. So we have digested this complicated chart and its outcomes. Then let's go here to the summation index for that was the McLennan oscillator summation index. It gave a buy cross a couple of days ago. Let's see here. That was, I believe, not yet on the 16th. On the 17th, we got a buy cross. So also this one is on a buy. It means that we have upside, right? Just as we had in different occasions as well, that we will see further upside. So this is also additional way to the evidence that we will see higher prices. We got quite oversold, not really below minus 500. Remember, as I said, I did the SI study for readings below minus 500, and then we would see 25 to 35% upside on average based on all the data that's available. We got really close, so we have to take it with a little grain of salt. But again, the preponderance of evidence points to higher prices, not lower. Then here is our long-term indicator, and it was bearish for most of December going into early January. And this one also switched to a buy cross once again, or a uptrend cross on January, let's see here, 15. Once again, January 15 was like the golden day. And we're back above a long-term uptrend. So, okay, similar what happened here in August, happened here in September, happened here in June, and it happened here in April of last year. Strong uptrend, etc. Again, it also shows there will be pullbacks along the way, right? An uptrend eventually will turn into a downtrend. But this is good. Also, again, additional evidence that the low is in place. Last but not least, the PMO indicator already went to a buy on January 7, which was a little bit early. There was definitely downside risk. And then we kind of had a leveling out and another, I would say, secondary buy signal on January 16. And that one has now been confirmed by the KST indicator that smooths things out. And previous signals you can see here were given in November, still upside. Were given here in September, still upside. August, we had first a little bit upside, downside, and then again upside for the next level. Again, shows you we don't always get the picture perfect signals. In May, a lot of upside, and again here in January, also a lot of upside. All right, so the KST indicator is like a confirmation for the actual PMO. Once again, additional weight of evidence that we should expect higher prices going forward over the next days to weeks, with of course pullbacks along the way, second or fourth waves or B waves. That is still to be determined. I don't know yet if we're going to see a 333 advance to those target zones, or if it's going to be a standard impulse. So that remains to be seen. But as long as we stay above these warning levels, higher it is. So that's where we're at right now. I think it is quite straightforward. And if you have any questions, please email me. I'm here to help. And I hope I have explained everything as easy as possible. And that you can see that the preponderance of evidence points towards higher prices, and that we might see pullbacks along the way. We will, and that's pretty much certain, along the way for whatever reason, but that now the general trend is higher towards those target zones that we already had in place since, I believe, somewhere here in November. Okay, so here in November, we started to wonder, are we already topping out for wave 3? That was just after Trump was elected, or are we going to see this ABC? Well, the market decided to do the ABC. That's fine as well. And now we also need to wonder, are we going to top out pretty soon for a initial rally of the lows, pullback, and then the second rally, or are we going to see a impulse that just keeps on subdividing higher? I don't know just yet. We need to see lower prices to be certain, but I'm sure you get the idea. Again, any questions, please let me know. Take care, trade safe, and I'll catch you all on Friday. Bye.